Q3 2025 is based on non-GAAP and excludes all non-cash stock-based compensation impacts, certain acquisition-related charges, and other non-recurring items. A full reconciliation of our selected GAAP to non-GAAP results is provided in our earnings release. With that, I will turn the call over to Jayshree.
Thank you, Rudy. And thank you, everyone, for joining us this afternoon for our second quarter 2025 earnings call. Arista is experiencing momentum in our business, as demonstrated in our record Q2 2025 results. We achieved $2.2 billion this quarter, surpassing our plan by $100 million. Software and service renewals contributed approximately 16.3% of revenue. Our non-GAAP gross margins of 65.6% was influenced by efficient supply chain and inventory benefit with a non-material tariff impact in the quarter. International contributions for the quarter registered strongly at 21.8%, with the Americas at 78.2%. Reviewing our mid-year inflection point, our conviction with AI and cloud titans and enterprise customers has only strengthened. We began the year with a pragmatic guide of 17% or $8.2 billion annual revenue, but as the year has progressed, we recognize the potential to build a truly transformational networking company addressing a massive total available market. This feels to us like a unique once-in-a-lifetime opportunity. We therefore raise our 2025 annual growth to 25%, now targeting $8.75 billion in revenue, which is an incremental $550 million more due to our increased momentum that we are experiencing across AI, cloud, and enterprise sectors. It is important to appreciate that Arista's AI center strategy is complementing our data center focus to drive some of this increase. AI centers consist of both scale-out front-end and scale-up, scale-out combination for back-end networks. Scale-up back-end networks consist of high-bandwidth, low-latency interconnects that tightly link multiple accelerators within a single rack as a unified compute system with workload parallelism. Today, this is predominantly constructed with NVLink as a compute-attached I/O, but we do expect a move to open standards such as Ethernet or UA-Link in the next few years. Scale-out back-end network is dedicated spines interconnecting XPUs across racks, engineered for high bandwidth and minimal latency, thereby resulting in efficient parallel processing of massive training models. Here, InfiniBand is rapidly migrating to Ethernet based on the Ultra Ethernet Consortium specification released in June of 2025. Scale-out front-end connects the back-end clusters to external clouds, compute resources, storage, wide area networks, and data center interconnect to handle data ingestion, orchestration for AI, and cloud traffic in a leaf-spine network topology. Arista's flagship EtherLink and EOS are key hallmarks of scale-out networking with a wide breadth and depth of network protocol support. Introduced in 2024, Arista's EtherLink portfolio is now 20-plus products with the most comprehensive and complete solution in the industry, especially for scale-out back-end and scale-out front-end networking. It highlights our accelerated networking approach, bringing a single point of network control and visibility differentiation and improved GPU utilization. Poor networks and bottlenecks lead to idle cycles on GPUs, wasting both capital GPU costs and operational expenses such as power and cooling. With a 30 to 50% processing time spent in exchanging data over networks and GPU, the economic impact of building an efficient GPU cluster with good networking improves utilization, and this is super paramount. Our stated goal of $750 million back-end AI networking is well on track and gaining from nearly zero revenue 3 years ago in 2022 to production deployments this year in 2025. As a reminder to you all, the back-end AI is all incremental revenue and incremental market share to Arista. As large language models continue to expand into distributed training and inference use cases, we expect to see the back-end and the front-end converge and coalesce more together. This will make it increasingly difficult to parse the back-end and the front-end precisely in the future. but we do expect an aggregate AI networking revenue to be ahead of the $1.5 billion in 2025 and growing in many years to come. We will elaborate more on this in Analyst Day in September, including our AI strategy and forecast. What is crystal clear to us and our customers is that Arista continues to be the premier and preferred AI networking platform of choice for all flavors of AI accelerators. While majority today is NVIDIA GPUs, we are entering early pilots connecting with alternate AI accelerators, including startup XPUs, the AMD MI series, and in AI and Titan customers who are building their own XPUs. As we continue to progress with our 4 top AI Titan customers, AI is also spreading its wings into the enterprise and neocloud sectors, and we are winning approximately 25 to 30 customers to date. The rise in agentic AI ensures any-to-any conversations with bidirectional bandwidth utilization. Such AI agents are pushing the envelope of LAN and WAN traffic patterns in the enterprise. So speaking of WAN, we are very pleased to announce the purchase of SD-WAN leader VeloCloud to offer modern branches in the agentic AI era. VeloCloud's secure AI-optimized WAN portfolio offers seamless, application-aware solutions to connect customer branch sites, complementing Arista's leading spines in the data center and campus. In a classic leaf-spine atomic identifier, we are enabling multipathing, encryption, in-band network telemetry, segmentation, application identification, and traffic engineering across distributed enterprise sites. We are so excited to fill this missing void in our distributed enterprise puzzle to bring that holistic branch solution. This also increases our foothold with managed service providers, MSPs, as an important route to market for our distributed campus and branch offerings. We also intend to work closely with best-of-breed security partners to enable SASE overlays. Please do note that Velo is not material in 2025, and we have some work to do to restore annual revenue back to pre-Broadcom levels. Last quarter, I shared the development and internal promotions of several tenured executives at Arista to bolster our leadership. They display that strong cultural synergy and a mission to ignite innovation and delight our customers. As we enter the next phase of Arista 2.0, growing from $5.8 billion in 23 to a forecasted $10 billion revenue in 2026, we rely on this trifecta foundation of great customers, innovative products, and great next-gen leaders to achieve this. I am so thrilled to welcome Todd Nightingale as Arista's President and Chief Operating Officer. Todd brings that incredible passion for networking with his over 2 decades of technical leadership in Meraki, Cisco, and most recently, CEO of Fastly. In just a month, he is epitomizing the Arista way, and I'm really looking forward to his impactful contributions to boost Arista's overall campus and enterprise operations. Todd, welcome to your first ANET earnings call. How does it feel to be here?
It's amazing. It's only been a month, but I can't tell you how impressed I am with the passion and focus of the team, the trust that Arista customers have in the technology, and the enormous opportunity we have ahead of us in data center, AI, and in the campus. I'll be primarily focused on our enterprise customer engagement, bringing new customers to Arista, and operational excellence across the organization. Personally, I'm so incredibly excited to be back in networking, and I'm truly, truly honored to be here. Thank you so much, Jayshree.
Thank you, Todd. It's going to be a fun journey here with us. You know, it's really an unprecedented time in networking, where Arista is so uniquely positioned to enable the modern network transformation. And with that, my dear friend Chantelle, over to you, our CFO, for the financial specifics.
Thank you, Jayshree. With that as the backdrop of our strong business outlook, let me now take us through the metrics that underscore our momentum. Total revenues in Q2 were $2.2 billion, up 30.4% year over year, above our guidance of $2.1 billion. This was supported by strong growth across all of our product sectors. International revenues for the quarter came in at $481 million, or 21.8% of total revenue, up from 20.3% in the prior quarter. This quarter-over-quarter increase was driven by a relatively stronger performance in our EMEA region. The overall gross margin in Q2 was 65.6%, above our guidance of 63%, up from 64.1% last quarter and up from 65.4% in the prior year quarter. The quarter-over-quarter gross margin improvement was primarily driven by improved inventory management and related excess and obsolescence reserves. Operating expenses for the quarter were $370.6 million, or 16.8% of revenue, up from last quarter at $327.4 million. R&D spending came in at $243.3 million, or 11% of revenue, up from $209.4 million in the last quarter. This primarily reflected higher new product introduction costs in the period. Sales and marketing expense was $105.3 million, or 4.8% of revenue, compared to $94.3 million last quarter, inclusive of a continued focus on our partner programs. Our G&A costs came in at $22 million, or 1% of revenue, down from last quarter at $23.7 million. Our operating income for the quarter was $1.08 billion, crossing $1 billion for the first time in Arista's history, landing at 48.8% of revenue. Other income and expenses for the quarter was a favorable $88.6 million, and our effective tax rate was 20.7%. This resulted in net income for the quarter of $923.5 million, or 41.9% of revenue. Our diluted share number was 1.271 billion shares, resulting in a diluted earnings per share number for the quarter of 73 cents, up 37.7% from the prior year. Now on to the balance sheet. Cash, cash equivalents, and investments ended the quarter at $8.8 billion. In the quarter, we repurchased $196 million of our common stock at an average price of $80.70 per share. Of the $1.5 billion repurchase program approved in May 2025, $1.4 billion remains available for repurchase in future quarters. The actual timing and amount of future repurchases will be dependent on market and business conditions, stock price, and other factors. Now turning to operating cash performance for the second quarter. We generated approximately $1.2 billion in cash from operations in the period, the highest in Arista's history, reflecting a strong business model performance. DSOs came in at 67 days, up from 64 days in Q1, driven by billing linearity. Inventory turns were 1.4 times, flat to last quarter. Inventory increased to $2.1 billion in the quarter, up from $2 billion in the prior period, reflecting an increase in our finished goods inventory, which is an outcome of our global tariff and supply chain management. Our purchase commitments and inventory at the end of the quarter totaled $5.7 billion, up from $5.5 billion at the end of Q1. We expect this number to stabilize as supplier lead times improve, but will continue to have some variability in future quarters as a reflection of demand for our new product introductions. Our total deferred revenue balance was $4.1 billion, up from $3.1 billion in Q1. The majority of the deferred revenue balance is services related and directly linked to the timing and term of service contracts, which can vary on a quarter-by-quarter basis. Our product deferred revenue increased approximately $687 million versus last quarter. We remain in a period of ramping our new products, winning new customers, and expanding new use cases, including AI. These trends have resulted in increased customer-specific acceptance clauses and an increase in the volatility of our product deferred revenue balances. As mentioned in prior quarters, the deferred balance can move significantly on a quarterly basis, independent of underlying business drivers. Accounts payable days was 65 days, up from 49 days in Q1, reflecting the timing of inventory receipts and payments. Capital expenditures for the quarter were $24 million. In October 2024, we began our initial construction work to build expanded facilities in Santa Clara, and we expect to incur approximately $100 million in CapEx during fiscal year 2025 for this project. Now turning to guidance. Building on this strong Q2 first half performance, we expect continued momentum in the quarters ahead. Let's first start with our outlook for fiscal year 2025. As Jayshree mentioned, revenue growth is now estimated to be approximately 25%, or $8.75 billion. This is fueled by demand across AI, cloud, and enterprise sectors, and demonstrates that Arista's focus on pure-play networking is meeting the innovation needs of the market. One item to note, of this revenue guide raise, we are now increasing our campus revenue target to be between $750 and $800 million, inclusive of the minimal amount expected from the VeloCloud acquisition in FY25. We are excited to welcome VeloCloud to our team, and as stated earlier, we are working through integrating and enhancing the business model to better serve our customers. For gross margin, a range is expected of approximately 63% to 64%, inclusive of possible known tariff scenarios and benefiting from improved inventory management. For operating margin, the outlook is approximately 48%, a testament to the ability of Arista to scale efficiently and effectively. Given the strength of our business and visibility into customer demand, here is our guidance for the Q3 quarter. Revenue of approximately $2.25 billion, continuing to serve our customers and win new logos across AI, data, WAN, and campus centers. Gross margin of approximately 64%, inclusive of possible known tariff scenarios. Operating margin of approximately 47%, and an effective tax rate expected to be approximately 21.5%, with approximately 1.275 billion diluted shares. In closing, this is a great time to be an innovative networking leader. We are halfway through the year with solid momentum and are clear on our execution priorities. This makes us confident and excited in our ability to finish the year strongly. In closing, I would also like to wish Todd a very warm welcome to the Arista team. I will now turn the call back to Rudy for Q&A.
Thank you, Chantelle. We will now move to the Q&A portion of the Arista earnings call. To allow for greater participation, I'd like to request that everyone please limit themselves to a single question. Thank you for your understanding. Regina, please take it away.
We will now begin the Q&A portion of the Arista earnings call. To ask a question during this time, simply press star and the number 1 on your telephone keypad. If you'd like to withdraw your question, press star 1 again. Please pick up your handset before asking questions to ensure optimal sound quality. Our first question will come from the line of George Notter with Wolfe Research. Please go ahead.
Hi, guys. Thanks very much. Appreciate it. I guess I wanted to, the results are terrific, certainly, but I wanted to ask about the competitive environment. I know many investors in recent weeks and months have been, looking at some of the growth at Celestica and certainly NVIDIA's networking business and kind of projecting some of that strength on, as being negative for Arista. I guess I was just curious about, your perspective on that, how you see the competitive environment, how you see your differentiation. Anything you can say there would be great. Thanks.
Sure, George, and welcome to Wolf. Thank you for the wishes. Look, we've always lived in a very competitive industry, whether it is, or I shouldn't say was, Cisco or specific networking vendors. And we acknowledge NVIDIA's participation both with InfiniBand and, bundling with the GPUs. We've always acknowledged the coexistence with white box. So from our perspective, the competitive landscape has not changed. It's more of the same, but I recognize that the chatter was louder. And we understand that, given the volatility of some of our customers, some years and some quarters are better. So I think some of the chatter was louder because our Meta share wasn't growing the same way as it did year over year the prior years. But from our perspective, our innovation and differentiation has never been stronger at a platform performance level, at a feature level. And I want to add a third one, which is at a customer intimacy level. They are so appreciative of the support, the quality, and the way we approach how to solve their problems. So no change in our environment and innovation, but plenty of chatter outside. I appreciate that. I understand that, and I hope we prove the naysayers wrong.
Super. Thank you.
Thank you, George.
Our next question comes from the line of Meta Marshall with Morgan Stanley. Please go ahead.
Great, thanks. Appreciate the question. I guess just on some of the strength that you're seeing in terms of cloud, I know it's getting increasingly hard to kind of differentiate front end and back end, but do you attribute some of the upside that you're seeing this year towards starting to see front end upgrades maybe quicker than expected, or is this just kind of back end demand being stronger than expected? Thanks.
Thanks, Meta. No, if you'll recall 2-3 years ago, maybe it's hard to remember all of that, I was actually very worried that the cloud spending had a little bit frozen and all of the excitement, enthusiasm was going towards GPU and, how big is your GPU cluster, that kind of thing. We now see it coming back, the pendulum swinging into a more balanced deployment of both cloud and AI. And I think as a result of all these AI deployments, as I've often said, the traffic patterns of cloud and AI are very different. The diversity of the flows, the distribution of the flows, the fidelity of the flows, the duration, the size and intensity. So all of that AI traffic and deployments we have done and others have done is now putting pressure on the front-end cloud as well. So that's why it's going to we wanted to measure ourselves as purely on the native GPU connections, but going forward, we see a much more distributed topology of cloud and AI sort of combining together. And it's not like HPC clusters where they'll build one and tear it down. When they build an AI cluster, it's very expensive. It's like diamonds, and they want to take advantage of that and bring it forward to other cloud resources as well. So to the point the question you were asking, our increased $550 million had a little bit of Velo, not material, as Chantel reminds me, but a lot of cloud and AI, as well as enterprise campus.
Great, thank you.
Our next question comes from the line of Ryan Koontz with Needham & Company. Please go ahead.
Great, thanks. I want to ask maybe a question for Todd, Jayshree, just about the fit for Velo with your traditional go-to-market motion, which has been heavily direct, and do you expect Velo to really beef up your channel efforts and working with these MSPs? Can you expand on that a little bit? Thank you.
Yeah, I think it's incredibly complementary on two fronts. One is it fills an enormous hole in the enterprise campus portfolio for the distributed branch, and being able to bring Velo technology through our traditional Arista channel, it gives us an opportunity to cross-sell SD-WAN into so many existing campus accounts with the existing Arista go-to-market, which is amazing. But Velo has a really strong MSP motion. We're pushing really hard right now in really embracing that, not just to continue the Velo success, but to now bring all of Arista's portfolio through that same channel, through those same partners, and really embrace that MSP motion and use the Velo intellectual property in their business operation in order to, learn from that and bring that MSP motion to all of Arista's portfolio.
Well said, Todd. Sometimes we're the engine and sometimes we're the caboose. In the case of the MSP, we're definitely going to leverage the strength of Velo.
That makes sense, Jayshree. Thanks so much.
Our next question comes from the line of Antoine Gabin with New Street Research. Please go ahead.
Hi, thank you very much for the question. Can you please remind us what's required for scale-up topologies and how that differs from scale-outs? Are traffic patterns more predictable, easier to manage, and how do you see the competitive dynamic evolving? Does this create more differentiation for Arista or more room for white box compared to scale-out?
Yeah. So first of all, I would say that scale-up is a new and unique requirement, and it particularly is going to come in as people start building more and more AI racks, right? So when you're building an AI rack and you want to boost the radix and performance of an individual rack or cluster, and your XPU radix gets bigger and bigger, you often need a very simple interconnect, right? This interconnect in the past has been PCIe Express, CXL, and now you're seeing a lot of NVIDIA NVLink where, you can really collapse your system board and an XPU socket into an I/O. It's almost not a network. It's an I/O. It's a backend to a backend, if I can call it that, right? And so scale-up networks will be an incremental new market as Arista pursues it. Today, majority of that market lies inside a compute network structure and isn't something Arista is participating in. But we are very encouraged by the standards for scale-up Ethernet that Broadcom has initiated and we're big fans of. We think that Ethernet as a transport protocol is going to favor Arista and Broadcom very much. And any little bit of incremental share we get there will be better than the zero we have right now. We also think UA-Link is another spec that's coming out, and that may run as an overlay on top of an Ethernet underlay. There needs to be some firm standards there because today, scale-up is frankly all proprietary NVLink. And we're encouraged by, just like we worked hard to found the Ultra Ethernet Consortium as a member for some of the back-end Ethernet, and the migration from InfiniBand to Ethernet is literally happening in 3 to 5 years. We expect the same phenomena on scale-up.
Thank you, Jayshree.
Thank you.
Our next question comes from the line of Amit Daryanani with Evercore. Please go ahead.
Yep, thanks a lot, and congrats on a nice set of numbers here. Jayshree, as I think about the 25% guide that you folks are talking about for the full year, which is really impressive, can you just talk about what are you seeing specifically that's enabling you to raise your guide from 17% to 25%? Just what markets or what vectors are you seeing that make you feel better about it? And then, do you see the potential for this higher growth to be more durable as, Arista realizes this once-in-a-lifetime opportunity as you talked about in your call? Thank you.
Okay, well, thank you for the wishes, Amit. As you know, it's not easy to execute on large numbers. So durable growth gets harder and harder as the numbers get bigger and bigger. But we've always believed in a CAGR of mid-teens. We've always believed in double digits. So we hope we will continue to grow for many years to come in those kind of numbers. Coming back to your question, I think when we guided the year pragmatically back in February, what Chantel and I saw was a lot of activity, but not a lot of confirmation. Sitting here in August now, that activity has translated in all three sectors into a lot of confirmation. Enterprise campus, I couldn't be more bullish. We had a record quarter in terms of demand. Obviously, we have to ship, but it's the strongest we felt. And as Todd might appreciate, since he created a lot of Meraki, as you look at the campus, this is going to be very strategic, very large, and very important because it's a large TAM of 25 to 30 billion. So getting new logos, getting our value and our differentiation, especially in the post-pandemic era, understood in terms of wired, wireless, IoT, segmentation, security, zero trust, zero touch provisioning was critical. We saw that shift happen in the first half of this year. On AI, I don't need to tell you that despite losing one of our key anchor customers, the fifth customer was a sovereign AI customer that's pretty much out of these numbers, we were still able to, we believe, achieve $750 million in back-end targets revenue and exceed $1.5 billion for the year. Exact numbers we'll know when we finally ship. We can't give you those specifics now. But despite losing one customer, we're having a lot of activity in the four big ones. And, it's pleasantly a surprise to us to see the advent of enterprise and even some neo clouds. The numbers are small. It's not as big as the large titans, but it's all adding up. And then the third thing, as I was telling Mita, was the cloud itself. When you start putting that kind of pressure on performance and bandwidth and capacity on the back end of the network, eventually you've got to go refresh the front-end cloud. So we're seeing many more migrations from 100 to 400 gig and even 800, and that's helping. So all three are contributing to this new growth we are projecting for the year.
Perfect.
Thanks.
Our next question comes from the line of Michael Ng with Goldman Sachs. Please go ahead.
Hey, good afternoon. I just have one and one follow-up. I guess for Chantel, I'm just wondering if you could just comment a little bit more on the deferred revenue or the billings growth. What was the primary driver there? And I was wondering if that was a contributor to the magnitude of the guidance increase that we saw. And then second, Jayshree, you mentioned the path towards $10 billion in 2026. Quite a ways out, but maybe you can just speak to some of the things that you're seeing. I know you talked a lot through it, but the confidence in that number and things that could break in the right way that could result in that number